Well, it was a long journey. When we started in 1985, there weren't diversified private equity firms. Basically, there were just about 7 or 8 firms that just did leverage buyouts. And when we started, I was worried that if you just did one thing, because there are no patents in finance, we had a strategy of wanting to go into other areas as long as it was really exciting for the investors, people we could raise money from.
So constant innovation, basically changing.
We started to have an innovation machine, and I thought it was just necessary, and we were the only people who wanted to do that. And so we got really lucky. We were good at figuring out what was next. You could sort of see it. We went into real estate in 1991, 92 at the bottom of a real estate collapse, and now we've become the largest real estate investor in the world. And we went into hedge funds in the late 80s, and that proved to be a really good thing in the debt business in 1998, before almost everybody else was doing that. And we've just had one thing after another, and each one I look at as an individual opportunity. No grand strategy of exactly where we go, but our job was to create new products and great returns with very minimum risk.
Steve, you mentioned that you are the largest owner of real estate, and there are people who look at that and say, oh no, commercial real estate in particular is a real problem spot, and that's been the area that, even though a lot of issues in the financial markets have worked out, people look to that to say that's going to be the next big problem. What do you say when people say, what do you do with this? Are you in trouble?
Well, the answer is it's a great area, but not all parts of it are great. So the part that reflects what you were just asking about is in the office area. And today, 20% nationally of offices are empty because people haven't come back to work. And at that level, office buildings are no longer really viable from an equity perspective. Now, the new ones really are. People want to be in those, but if it's 10 or 15 years old, then you have that problem. We had tons of office buildings at the financial crisis. 70% of what we owned. Today in the United States, we only own 2% of that problem area. The rest of what we own is where real estate is really terrific. Warehouses, for example, are about 40% of what we own. They're going up 12 to 14% a year in rents. Hard to imagine that that's a problem, because it isn't. There are other areas in real estate like data centers, which are literally exploding with growth. Rents are going really high. So what we find in real estate, there are good neighborhoods, in effect, and some really not good ones. And our portfolio is hugely biased to the good areas.
When did you see the problems with commercial real estate with the office buildings and say, we got to get out of this?
It started in the late teens. And we were finding that the cash flows coming off of those buildings weren't what they used to be. The cost of running them, capital expenditures, other things, and we decided that we should really lighten up, and we did. We made a huge switch. We switched out of shopping centers around 2015. And so part of the art of really being terrific in the real estate business is knowing which sub-asset classes to be in. So resort hotels, which we also have a bunch of, I don't know what they call it. Is it revenge spending?
Yes.
After the pandemic, we made a profit. I think it was over 10 times our money in Las Vegas with a wonderful hotel. And so if you're consistently in the right place at the right time, real estate, which is the second biggest asset class in the world, is a really wonderful place to be.
I remember, what was it, a year and a half ago, I think, you started talking to your businesses about the potential for a downturn and making sure that all of your companies were really kind of getting their things in order and making sure that they were ready to go if the cycle turned down, if interest rates went higher. What are you telling those companies right now? What do you see?
Well, we were right on all that. You know, we had the banking crisis over the last few months, and being conservative and having good financing was the way to go. The world is changing somewhat now, as you know. Instead of really going into recession, U.S. growth was 2.4% in the last quarter. It shocked almost everyone. And so the U.S. economy is more resilient. But what's really fascinating is how much inflation has gone down. And if you remember, you know, my partner John Gray goes on your show periodically, and we've been talking early that inflation was way more than the government was reporting. I think that was true. And then we started talking about the fact that inflation was going down much more than the government thought. And we're seeing it in our companies. And I guess there was just a report of 3% inflation. That in no way surprised us. And so it looks like the Fed is actually doing a pretty remarkable job, contrary to what people might have thought. And if the inflation continues to go down, that we have full employment, then we may be able to skirt a recession.